First, let's look at the daily time frame. What we see here is a clear bullish break of structure, or BOSS. This occurred back in early July when the price decisively broke a previous major high, signaling that the buyers were in control and establishing a large new trading range between the low and the high marked on the chart. Following this, the price rallied, took out liquidity above the new high, a move often called a liquidity grab or deviation, marked here as X, and then began its retracement. This pullback is not a sign of weakness, it's a healthy market dynamic. The price has now come down into a key area of demand, labeled here as the order block. This is a zone where significant buying interest is expected. We've also seen the price interact with a level of inducement, or IDM, which often precedes a move from a key zone. The reaction from this daily order block is our foundational reason for having a bullish bias. Now, let's zoom into the 4-hour chart to see how this daily idea is developing on a smaller scale. On this time frame, we can see the price action more clearly. The price has established a smaller range within our larger daily structure. We're observing a bullish order flow, meaning the price is respecting demand zones and failing to break below key lows. It has taken out inducement IDM and is now pushing upwards, confirming that buyers are stepping in at these lower prices. This aligns perfectly with our daily bias. Dropping down again to the 1-hour chart, the picture becomes even clearer here. We see another recent bullish break of structure BOSS. This is a critical development. It shows that the momentum on this lower time frame has now officially shifted to the upside. In alignment with the higher time frames, the market is creating higher highs and higher lows. The analysis anticipates a pullback to mitigate a demand zone before continuing its ascent. The area marked liquidity below the recent lows has been taken, clearing the way for a more efficient move up. The projected path is a dip, followed by a rip to new highs. Finally, this brings us to our actionable trade idea on the 15-minute chart. This is where we combine all our analysis into a precise entry and exit plan. Following the 1-hour break of structure, we've identified a refined demand zone for a potential long entry. You can see the projected price path here. We're waiting for a slight pullback into the teal box, which represents our buy zone. Let's break down the trade parameters. Entry. The entry is planned around the $111,759 level, which is the top of this 15-minute demand zone. Stop loss. The stop loss is placed just below the low of this zone, around $110,925. This invalidates our trade idea if the price breaks this critical level. Take profit. The target is set at the recent high, around $114,000. Most importantly, this setup offers an excellent risk-reward ratio of 3.18. This means for every dollar we risk, we stand to gain over $3. This is a key component of a high-probability trading strategy. We aren't just predicting the direction, we're ensuring the potential reward justifies the risk. So, to recap our analysis, daily chart, we have a strong bullish bias after a reaction from a major order block. For our chart, the bullish order flow is being respected, confirming bear interest. 1-hour chart, a recent break of structure has shifted short-term momentum to the upside. 15-minute chart, we have a specific, high-probability long setup with a favorable risk-to-reward ratio. This top-down approach ensures that our lower time frame entry is aligned with the broader market direction, increasing the probability of success. We're now simply waiting for the price to pull back and give us our entry. Thank you for joining us for this market analysis. As always, this is not financial advice. Trading involves significant risk, so always do your own research and manage your risk carefully. We'll see you in the next one.